Hey, how's it going? Bill Lethman here for Money Evolution. In this video, I'm going to be talking about the Tax Cuts and Jobs Act and who really benefited from this massive tax legislation that went into effect in 2018 and is scheduled to expire at the end of 2025. Well, here we're in the middle of another very contentious political environment, and I'm hearing a lot of people talking about how the Tax Cuts and Jobs Act rate, or the so-called Trump tax cuts, really only benefited the wealthy. So in this video, I'm going to be breaking it all down, and I'm going to be looking at two hypothetical individuals. One that's right at the middle of the entire income spectrum, and that's going to be a median household income, which for 2023 was somebody making $80,610. And so we're going to be comparing the amount of tax that this household, we'll say, paid in taxes under the Tax Cuts and Jobs Act rate, and then what their taxes would have been if we were still under the pre-Tax Cuts and Jobs Act rate. And then I'm going to be comparing that to another hypothetical individual, which is going to be somebody that is in the top 0.1% of income earners, and they have, we're going to say, $3.3 million of taxable income. And we're going to be running the same thing. We're going to be looking at what they're paying under the Tax Cuts and Jobs Act rate, and then what they would have paid under the previous tax rates that existed before that. And again, these tax rates are going to be expiring at the end of 2025, and I think it's a very big issue. I personally would love to see the Tax Cuts and Jobs Act rates extended. As we're going to learn here in this video, they didn't just help the wealthy. They did help the wealthy, but they also helped some of the people at the lower end of the income spectrum, and really in terms of percentages, as we're going to learn here, they actually help these people at the lower end of the income spectrum in terms of percentages much, much more than some of those people at the higher end. So it kind of debunks a little bit, and I'm giving a little bit of a spoiler here. But what I'm going to be doing is kind of getting into the math so you can really understand how this works. It's also going to hopefully help you to understand how your individual taxes are being calculated. I just did a video here a few minutes ago about that, talking about the different types of income, adjusted gross income, modified adjusted gross income, and all those different things, and what it really means. So my job here, what I am doing and what my purpose is to educate you, not just about taxes, but about all things financial. That's kind of been my mission from day one for Money Evolution. In fact, what we've been doing here is building out our website, totally redesigning it, and really making it sort of into a financial resource super hub where we've got information about all kinds of different topics, and of course we've got the channel here. So anyway, we'll put some links down in the description below if you want to check any of that out, and also if you want to learn more about what we do with our financial planning, we'll put some links down to some of those programs down there as well. Okay, so before I get into the specifics and some of the math here that we're going to be talking about here today, let's take a moment and just talk a little bit about kind of the highlights, if you will, of the Tax Cuts and Jobs Act. So number one is it created a new tax table for ordinary income, and across the board for all levels of income, all income categories, it created a lower tax bracket for every filing category. And as I always say, or I've said in the past anyway, in other videos, there's really two aspects to our taxes. One is the rate that we're paying on our taxes. That's obviously very important. But the second piece of it is really the amount of that income that's subject to tax. And so those are two things that kind of go hand in hand. So just because we get a lower tax bracket doesn't necessarily mean that we'll save money in taxes if it means that we're going to have to pay taxes on a higher percentage of our income. The second thing that the Tax Cuts and Jobs Act rate did was it increased the standard deduction and actually basically doubled it effectively. Double that from what it was prior. And so what that led to was a much, much bigger percentage of people that are now taking the standard deduction as opposed to using itemized deductions. And so that simplified their taxes, made it easier for them to do taxes, and really, quite honestly, benefited a lot of people in this category, and probably didn't benefit people at the upper end of the income brackets because they were probably doing itemized deductions anyway. The other thing that happened there is it removed the personal exemptions, okay? And so that was a That was a amount that you got to deduct for every person in your household that was dependent on you. You got to deduct an amount, I think it was like $4,000 or something like that per person. So that's been eliminated. So typically, depending on how many people, you had 2 people, the standard deduction probably made up for the fact that the personal exemptions were cut out. And that's kind of the way it worked. The other thing it did was it greatly enhanced the child tax credit. And so the child tax credit was $1,000 under the old rule, so now it's $2,000. So it basically, not basically, exactly double the child tax credit. It also greatly expanded the number of people that can qualify for a child tax credit. It used to be relatively hard. You had to be kind of at the lower end of the income spectrum to get one of these child tax credits. But now, if you're married filing joint, you can make up to $400,000 and get that credit. Or if you're single, you can have a $200,000 income and get that child tax credit. So a family of 4, if you kind of put it all together, you were probably slightly ahead by the time you factored in the doubling of your standard deduction, didn't get the personal exemptions, but then got maybe a couple of child tax credits thrown in there, kind of made up for that. You start getting into maybe a family of 3 or a family of 4, then it maybe starts to negate some of those benefits a little bit there, but the child tax credit does a pretty good job of covering that. One kind of interesting side note that I just wanted to clarify, you may be wondering, or maybe you're confused about a tax deduction versus a tax credit. Very important distinction there. They're 2 completely different things, but a tax deduction reduces the amount of income that's subject to tax, and a tax credit is something that goes directly towards your tax bill. So if you owed $3,000 in taxes, but you had a $2,000 tax credit, that would go directly against it. So a tax credit is always going to be better than a tax deduction. Okay, and then 2 more things that happened as a result of the Tax Cuts and Jobs Act. One was something called the state and local tax, I abbreviate that SALT. They're now limiting that to just $10,000. Okay, so that's going to be your property taxes, that's going to be any state taxes that you paid. All of that stuff was deductible as an itemized deduction off of your federal tax return. So for people that have a lot of property tax that they're paying, because they have big houses and a lot of property tax bills associated with that, and people that are making a lot of money also are probably, depending on the state they live in, maybe paying a lot of state income taxes as well. So that's now capped at $10,000. So that really very negatively affected people that are probably in those higher income tax brackets, because they're not being able to take as much of a deduction for some of that. And even somebody that's making a modest, even a middle class person, may have a decent amount of some of those state and local taxes that they're now going to be very restricted on. The other thing they did was they changed the amount of interest deductions you can take for home mortgages. So it used to be that you could deduct interest on up to $1 million of indebtedness, and now it's only $750,000. So again, those are things that obviously are affecting people at the upper income bracket. Somebody making $86,000 a year, probably doesn't have a $750,000 mortgage or $1 million mortgage, but that's going to reduce the amount of deductions that they can take to reduce that income. Okay, so hopefully that's a pretty good overview that kind of recaps a little bit about some of the major changes with that Tax Cuts and Jobs Act and kind of how some of the math is going to work. So now we're going to really kind of nerd out a little bit here, and I've got a bunch of numbers that I pre-calculated here that I'm going to walk through and really get into the details. So if you like that sort of thing, keep watching, because I think we're going to get pretty interesting here. So again, we're going to be looking at the median household income. Again, for 2023, that's somebody making $223,000. We're going to assume a couple of things. We're going to assume that this is a family of 4, and we're going to assume that the kids are under 17, so they're going to qualify for this child tax credit in there. So how this is going to work and how your income is calculated, and we're going to assume, just to keep things relatively simple, this is all ordinary income. We're not going to get into taxable dividends and long-term capital gains and things like that. So the first thing we're going to do is we're going to take our standard deduction, and we're going to assume that that $29,200 is more than what they could come up with through deducting some of these state and local taxes and other things that you would get to deduct there. And so their taxable income there is going to be $51,410. Okay, so again, remember it's how much your money you're paying taxes on, not your tax rate, or it's a combination of that. So if we run that through the tax table, we're going to have $5,705 is going to be their tax. If we assume that the two kids are getting that child tax credit, we're going to subtract $4,000. So the tax credit is $2,000 per child, and so that's going to leave them with $1,705 is going to be their total federal income tax bill. That doesn't include your state taxes, obviously. If you have, if you're working, there's going to be some FICA taxes, but that is your U.S. federal income tax, and that's going to be an important number to keep track of. And as we look at it, what it would have been under the old tax rules, we'll be able to compare that. Okay, so let's take a look at this, and we'll say pre-Tax Cuts and Jobs Act. We've got the same amount of income, $80,610, and we don't know what the tax brackets will be in 2024 using the old tax table. But what we can do is we can use the tax table from 2017 and apply some inflation to that, so we can kind of see, okay, based on inflation, what would that tax table look like today? Because as you may know, or maybe don't know, every year the tax table rates or the thresholds anyway, they go up a little bit with inflation. So we also inflated the standard deduction. So they had a standard deduction, which again is about half, so $15,034. And then we're going to assume some personal exemptions. So the inflation adjusted personal exemption was $47.94 times 4 equals $19,177. And when we subtract that, we end up, so we're going to basically subtract from the 80,000, 15,034, personal exemptions of 19,000, and that's going to give us 46,398 of taxable income. So not bad. So already, we're looking at, okay, so under the new tax rules, they're paying tax on 51,000. Under the old tax rules, they're paying taxes on 46,000. Okay, but again, there's two components, how much you're paying taxes on and then the tax rate. So with the old tax rate, $46,398 actually came up with $5,856 in tax. So that is just on the base tax calculation. If we're comparing these two numbers, we're actually a little bit higher. So even though we have less taxable income because the rates were higher, there's about $150 difference in taxes. Not a big deal. But again, we're also going to get a child tax credit, and this individual under the old tax rule would have actually qualified for a tax credit there as well. But again, instead of being $4,000 for two exemptions, it was only $2,000 for two. And so that left you with $3,856 in tax. So if we compare this and we look at who benefited, or at least who benefited in this case, under the new tax rule with the Tax Cuts and Jobs Act rate, $1,705 is our federal tax due versus $3,856. That is a difference, a savings of $2,151. That's huge. But it's also, if we put it in percentage terms, 56% tax savings. We overcut their tax bill in half. We didn't do it. I didn't do it. But the Tax Cuts and Jobs Act rate did it. So that's huge. That's a big number. Now we're going to get into the numbers of what it looks like for that person that's in that top 0.1%, $3.3 million of taxable income. Okay, so now let's take a look at our other hypothetical person here. So this is going to be, we're going to assume a couple making $3.3 million of taxable income. We're going to keep it pretty simple. We're just going to assume this is all ordinary income because we're not going to really get into the details of the preference income and things like that. But we're also going to assume a couple of other things just to give us a little bit more background. We're going to assume that they have two houses. If they're making $3.3 million, they're probably really nice houses, probably multi-millions each. Many people making that kind of money might even have 3 or 4 houses. So we're going to be relatively conservative here with some of this and say that they have $50,000 a year in property tax. We're going to assume also too, hopefully if they're making that kind of money, they're giving some good money to charity. I think a pretty low number for this would be to assume that they have maybe $50,000 a year of charitable contributions. And then we're also going to assume that They're paying some state income taxes. Not every state has a state income tax. Some are pretty high, like New York or California. We're here in Michigan. So we're going to use the Michigan tax rate, which I think is right kind of in the middle of where state income taxes go. And the state tax for Michigan is 4.25%. So based on all that income, we're going to assume that they have about $127,500 of state tax, tax for the state. And then we're also going to assume some mortgage interest. So if you remember, or maybe we talked about it, that if you had mortgage interest under the old tax rule, you could have deductions on your interest up to $1 million of indebtedness under the old rule, but under the Tax Cuts and Jobs Act, that's only at $750,000. So under the old rule, they would have, let's say if they had $1 million or more of debt, they could have $30,000 of interest that they would also be able to deduct. So all of that, when we add all that up, is $257,500 is the total amount of deductions. So that gives us a little bit of a frame of reference. But let's begin by looking at the Tax Cuts and Jobs Act, and let's see how this all kind of plays out here. So we have our Tax Cuts and Jobs Act, so with $3,300,000 of, let's say, taxable ordinary income. Doesn't matter all of that stuff about the $50,000 of property tax and the state income tax and everything, because all of that gets reduced to just $10,000. So the $50,000 in property taxes and the state tax, to be $177,500 of deductions, that gets completely eliminated. Instead, under the Tax Cuts and Jobs Act, they only get to deduct $10,000 of that. They're also going to get their interest knocked down a little bit there from $30,000, because it was on $1 million, to $22,500. Based on the fact that they can only deduct the interest on up to $750,000 of indebtedness. We're going to assume they're still giving the money to charity, so $50,000 there. That leaves us with $3,217,500, and so that is their taxable income after taking those deductions. If we run that through the Tax Cuts and Jobs Act table, that means that they paid tax of $1,084,410. Okay, now what we're going to do is we're going to compare that to what it would have been under the old tax tables and old tax rules before the Tax Cuts and Jobs Act rate went into effect in 2018. Okay, so let's look at how this looks under the pre-Tax Cuts and Jobs Act rate. Okay, so we have our $3,300,000 of income. And then we're going to look first at our itemized deductions. So we had itemized deductions of $257,500. But many people don't realize that there was a phase out of our itemized deductions. So in 2017, if you made more than $318,800, your itemized deductions actually started to get reduced by 3% for every dollar you were over that limit. And so that can end up being a pretty good deduction or reduction to those itemized deductions. If we adjust it for taxes, so it's $313,800 in 2017, it's $371,483 in 2024, inflation adjusted numbers, and so that means that we took that off. We subtract that from the $3,300,000, $2,928,516, and you see why our income taxes are so complicated. They don't really need to be, but they are. And then we're going to multiply that by 0.03, and that's going to tell us that we're going to have our itemized deductions reduced by $87,855. And that means that instead of having $257, we now have $169,645 is our itemized deductions. Okay, and personal exemptions, which we talked about earlier, for their level of income, those were completely phased out. I don't have the exact number where that was, but that was somewhere in that 300,000 range as well. If you were over that number, you would have been completely ineligible to take any personal exemptions, so we won't subtract that. And so after subtracting the only thing we can subtract, which is our itemized deductions, it left us with $3,130,355, was our taxable income that we're going to run through the tax table. So just to give us a little bit of a reference there, so it's a little bit less because they had a little bit better ability to take some deductions than what we were limited to by the new tax rule. But we're also going to see what that looks like when we run it through the tax table. And when we run it through the tax table, our total tax was $1,174,790. So it was a tax savings of $90,380. Big number. But again, either case, they're paying a lot of money in taxes. So that $90,000 is a lot of money in terms of dollars, but it was a reduction only of 7.69%. So what I would say regarding the Tax Cuts and Jobs Act rate now versus the old tax table, who really benefited? Well, everybody pretty much benefited. I think there'd be hard pressed to find any category of tax filer where you didn't see some benefit in the new tax rates that are out there. But clearly, you know, you could say on one hand, people at the upper end of the income spectrum benefited more because they're saving a lot more money, and they're saving $90,000 instead of a couple $1,000s. But in terms of percentage, who really benefited the most? Well, somebody that's making $3.3 million saved 7.69, whereas somebody that was making $80,000 was saving 56%, so a much bigger reduction. And there'd be really no way, because even under the old tax rule, somebody making $80,000 was only paying about $5,500 in taxes. So unless we gave them a huge tax credit to offset that, it wouldn't probably make sense anyway. So anyway, I hope this makes sense. And my board kind of glitched out a little bit in here, so I had to pause it a couple times and figure out what was going on. I think it's an internet issue that this board is connected to. But anyway, digress. Anyway, I hope this was helpful, at least to kind of understand if you're, thinking about it. Maybe you're somebody that's saying, hey, you know what? These tax cuts only benefited the rich, and when they go back, I'm going to get, hit with higher taxes or whatever. Really, it's just not necessarily the case. You just have to look at, where you fall in that spectrum. But either way, I think most people are probably going to save some money in taxes. So anyway, check out some of the links down in the description below. And we've got our programs, the Money Evolution Plan, and our Retirement Time Machine, which is our self-guided retirement plan that will walk you through from beginning to end and create a working, very high-end, very high-level financial plan that you can use to start making some of these big, important decisions regarding your money, regarding your retirement. Check out those links in the description below. Be sure to like and subscribe to our channels, and look forward to seeing you back in one of our next videos. Thanks.